All right, guys, welcome back. Here we have Euro USD on the monthly time frame. This is example 2 out of 4. So what do we currently see on the monthly time frame? We have a run liquidity, breaker structure, and then we have our weak high right there. Also, it looks like we got some equal highs, crown liquidity forming, right? So now let's zoom in into what's currently going on right now. So without even going to the weekly time frame, we already see run liquidity, break a structure, and then we also have our weak high right here. So a range right here, and then we have the bigger range right here. See that? Nice. So price is currently right now in a unmitigated monthly wick. Unmitigated monthly wick. If we break this down to the weekly, it looks like this, right? It's lining up with this order block right here. This order block right there. That's where price is currently lining up. Now, we also have internal liquidity right there. We also have some inducement right there. So this makes it a valid area for price to give us some type of reaction, right? Like I mentioned in the first video. So let's go down to the daily time frame real quick. So what do we see in the daily time frame? In the daily time frame, we see a run of liquidity, and then we have a break of structure, right? So we know this is already a high. That is a untested QM. So we know that we can expect some type of reaction from here. Now this big zone right here is actually the weekly order block. This is a big block. It's a big zone, right? But this is the POI right here. When we go to the daily, we're able to refine this down to the what? To the breaker right here. That's the breaker. This is a point that took out liquidity. For the retail perspective point of view, it took out structure for them. It took out liquidity. Price was supposed to react and continue going up higher, but it didn't. So that makes it a what? A breaker, right? It broke straight through. The order block did not hold. So it's a breaker. So we know we can get some type of reaction from here. So we understand where we're at in the higher time frame. Now, guys, you see how we always use the higher time frames? We need to use the higher time frames. Higher time frame, right, with lower time frame entries. So it's higher time frame direction of bias with lower time frame entries. So when price came into this weekly, for here in the weekly, it was an order block, and on the monthly, it was a unmitigated wick. So when price came into here, went straight down to the 4 hours, see what we can see, because we need to confirm, obviously, the range from here to here, because in the daily, there's nothing clear here. And then in the 4 hour, obviously, here's where we were able to see the confirmation of that range. Those green dots is the confirmation of that current range right here. So from here to here, that's the QM right there. See that? Now, let's get into the details. So when price came into this, delete this, into this point of interest, delete all this, I don't know why that was there. Right, into this point of interest, right? What is the most logical time frame to use? Now we can use a 4 hour and the 1 hour down to the 15-minute. I wouldn't go lower. Yes, you can. You can go down to a 5-minute, even seconds time frame, but that would be a personal choice. I personally will stick with anywhere from 4, 1, and 15. That's just me. Some of you may see some good results with going to the 1 minute seconds, but keep in mind, right? If you don't have the right POI, or even if you have the right POI, there's a high chance that you can confuse, let's say, a break of structure to go along with simply a retracement to keep going shorter to the downside, right? So that's why let's try to stick with the highest time frame possible where you currently see what's going on. Now, let's put this back. So here, that's a high, that's a BOS. We don't see a high here. We do not see a QM. So from the 1 hour to 30, it doesn't look so clean, but we can see it right there. Look at that. 3 kind of formation, run liquidity, break of structure. So that's a high, it is a Quasimodo. Now we need a low to confirm that that is the valid well, not quasi-model low, but the valid low of this range right here, right? So when play this out, the low was formed down here. Now you see how it's being shared. Again, it's being shared. The red and the green is being shared. We'll talk about the red in a bit, but the green and the red is being shared. Now, if we drop down to the 15-minute, you see a clear high, Quasimodo, and then you see a clear low. Don't know why it's doing that. A clear low. So here in the 15-minute, we have this high that took out liquidity. So once this high got broken, this confirmed this range from here to here. Not only is it the high that confirmed this range, it's also the inducement feeding into this point of interest. Is that making sense? Remember, the market is fractal. Everything is fractal. All right. So this high right here is what confirm my broker structure, and it's also my inducement. Okay, from this range here to here. What model is this? Look, price broke structure, retrace broke structure once again. Imagine how many people are going short here. A lot of people. Now, not only wouldn't we go short there because of this, we wouldn't go short there because we are inside of a higher time frame point of interest. And that's very important to keep in mind. You cannot forget where you're coming from. So we have a lot of reasons, right, to ignore this short. Now, you can take this short. There's nothing wrong with that. At the end of the day, it meets your rules. But to get a high probable scenario, I will look for longs. Now, this did come in here during New York. So eventually you wouldn't have seen any of this. So that would have been visible. So this short would have been possible because at the end of the day, the only thing you had was this and this. So you're going to trade what you see and not what you think. So that would have been your current short, right? However, you would have kept in mind the bigger picture. The bigger picture is that price can come into a higher time POI, not the weekly, but now this time a 4-hour daily, right? And keep on going higher because we are inside of a higher time frame point of interest. All right. So price came down. It came into a higher time frame point of interest. What POI did it come into? So let's go to the higher time frame, stuff in the 4. So we have a rejection block, right? A huge rejection block right there. That is the point of interest. Go to the 1 hour. It's also a rejection block. So go to the 30. It's just an order block. 15-minute. It just becomes a breaker. This right here becomes the breaker. So you can refine this to the breaker right there. That's the breaker, right? Price came here around 9 o'clock. As you can see, that right there is the breaker. Put that back, right? So if you took a direct entry from here, you would have got tagged in and instantly got tagged out, right? And that happens, right? You're taking a direct entry. So we know the pros and cons of a direct entry. So that would have happened. You would have got tagged out, I believe multiple times. Yeah, you would have. It would have taken you out, right? Why? Why is that? Because this entire thing is a POI, it's a point of interest. Now, let's say you took a trade here, right? Took a trade here, and you went long, and your stop loss was just like right here, but that's 15 pips. That wouldn't have happened. And even if you took it directly, this is well over 11 potential pips. So again, what if you took in this? That would have been a personal choice, right? I mean, there's a big zone. Might as well just wait for confirmation. I would have. It's just huge. It's a huge stop loss. That's the breaker. And yeah, based on our rules, there is a breaker inside of a higher time frame. POI, I would have waited. Now, when price came there, this point right here failed to take out that high. That becomes weak. That's a failure swing. If this was a true low, if this was the true low, right, then why didn't it take out that high? So that became weak. That now became inducement, and that got taken. You see that? Just like that came in around 14 o'clock. That is around 4 o'clock my time. So no trade. That's out of session. So now remember, we don't trade during Asia. We let Asia finish. let it build up, and we trade after that. But I was just showing you what happened so you can understand what is happening. Now, all of this, don't forget, all of this is a POI. That is a 4-hour rejection block, 1-hour rejection block, right? So 2 of those. This is a POI. It's a point of interest, right? So you can now start to drop down to a lower time frame instead of 5 minute and see what's going on here because it took out this low, right? So now we got to see. Now remember, this red right here is a range. That's a range right there. All of this is a range. So we got the green with the red being shared, but now the red created its own range. So it came down, took out internal, and now what's the overall target? External. So we know where our overall target for this range is at. See that, right? That's what we currently have. Now, let's play this out. We'll get into this green area here, and I'll explain what's going on there. But let's continue from here. So what's going on here? We have a round liquidity, breakup structure. Now we have a new range created from here to here. Now I can't go to the 1 minute. It won't allow me because I'm a replay tool, but we already know that a strong high creates a weak, that strong low creates a weak high, right? So that was weak. So during Asia, that happened. We don't care what's going on during Asia. This actually took this out. As you can see, it took it out by pip. Let me zoom in right there, took it out. So that becomes the new low. And like I mentioned in the sessions video, that if Asia becomes a strong low, there is a 90% chance that it's going to hold. All right. So keeping that in mind also. So Asia is forming. All right. And then London is about to open. So London's about to open. So now let's go back to the 15 minute, see what we got going on here. All right. So now we have a new range from here to here. We see the liquidity being formed right here. Now we got to find our higher time frame POI. So let me just put this back. All right. So now we got to find our higher time frame POI. So let's start from the 4. So we got here. So we have a unmitigated 4-hour wick. Is the closest thing to the POI. I mean, is the closest thing to the liquidity right there. This POI is the closest thing to liquidity right there. Those lines right there that are marked up, that's the liquidity, right? So that's my POI. I go back to the 15 minute. And if you don't see liquidity, you can see here clearly right there, internal liquidity. All right. So now for this current long, this is my current range from here to here. Inside of this other range, inside of this other range, a range inside of a range, inside of another range, okay? All right, do all that. So let's say it took it directly here during London. All right, a nice 5.8 stop loss, a nice 1 to 5. You either take it all or you take some partials, up to you. But because you understand that you're in a higher time for POI and you understand that you're on a 4-hour, 1-hour POI, then we can aim for at least this for a 1 to 13. 1 to 13, it is a good risk reward. I would take it out there and I'll be done for the day. That'll be me. So price taps you in, now you're in, right? So play this out. So wait for New York to open. All right, so now we got a new range from here to here. A new range was created, right? So let me put this back. Let me get a new range from here to here. Okay, this is internal liquidity, yes, but again, we got to go to the higher time frame and see what's going on. So this is a new range. Let's drop down a bit to see if we can see the ranges. I see it here, right there. Oh, put this back. I just moved it. Give me a second. There we go. Right, it's right here. Do you see the low? There is your strong low right here. We took out liquidity, we broke structure. That is your strong low from A to B. That is your newfound range. Okay. This internal liquidity, yes, it is. For this range, yes, it is. However, we use a higher time frame to identify where we're going to enter. Right? There's people waiting to enter here, here. That's why there's so many POIs. But the question, which one do you choose? That's why we use a higher time frame. The higher time frame is what rules the market. So first, identify liquidity. So we've identified it right here. After these three kind of information form, that gave us the liquidity. Now I can't go lower. I wish I could. That is actually an inducement point on the 1 minute. So that's being fed into something. So now let's go all the way to the 4 hour. And all we see is this order block right here. This order block and then a push down, right? That's an entire order block. Remember, the wick is an order block on the lower time frame. It's only a wick on the higher time frame, right? But in the lower time frame is the order block. Is simple as that. So that's an order block right there. That's the open, right? We'll go for the open. The volume is there. And then there's no imbalance. So obviously we'll go for the open. We have no reason to go for the imbalance. To go for the wick because there's no imbalance. So we'll go for the open. There's a volume. On the 1 hour, lines up with a breaker, 30, and then the 15 minute lines up with this order block. So we got confluences of events right here. Everything lines up. That would be a direct entry if you want to take it directly. If not, wait for confirmation. This blue line right here. So price comes in. Again, depending if you take it directly, high chance you would have got stopped out. That's just normal. There's, all you can do is control your risk. But as you can see, these levels work out perfectly. Look at that, perfectly. Right now, perfect, not as if like taps and goes, but perfectly as if just look at it play out from these key levels, higher time frame, right? Now we know that we can avoid losses by waiting for confirmation. As simple as that. But for those that want to take direct, you know the pros and you know the cons, so you can't complain. So then price goes from there, and then eventually on the smaller time frame, which I can go into, we had this. Well, we had this to this. We had internal liquidity that was just internal liquidity. Nice. Equates to being built. Then we had rejection block right here. So that would have been another long right there, and then to the upside, right? I'm sure you see it right there. So let me remove. Well, not remove, but let me put that away. Okay, so now we get a new range from here to get liquidity, broke structure. That's a newfound range. Play this out. I think, yeah, now this is going to a whole new day. All right, so now let's get back to the green range, which I think we saw it on the 1 hour. Yeah, all right. So now this right here is a green range, right? So like I mentioned, let me go to 15 minutes, we can see clear as day. All right, so we have this high, we broke structure right here. We create the inducement, broke structure once again. This point was supposed to make a low, but it didn't. It is a failure swing. And we already know why it didn't make a low, because we're in a higher time POI, so we were expecting that long. And because it failed, that became what? That became liquidity, that became inducement. And by liquidity, I mean, because look, we got equal highs, we got trend line liquidity right there. Let me clear out this mess for you real quick so you can see it. I mean, look, guys, look at this. There's a reason for everything. The market builds the liquidity right in front of our faces, but it's up to us to see it. Look at this. Trend line liquidity. Look at this impulsive push. While we were looking for longs, it was already building up the liquidity. See that? So that becomes weak. So that's why I said, if we understand that we're in a higher time frame POI, we could have obviously exit here in this range because that's where the long came in. We could have obviously exit here, but we know that this is a failure swing, so we can exit here. And your overall move would have been this, 1 to 14, right there. And that's the end for the day, because here's a brand new day that starts. So all of this happened within 1 day, right? We kept everything in mind, everything, the higher time frame, ranges inside of a range, another range inside of another range. Okay, I am talking a little bit faster on these chart examples because if I talk slow, they would take forever, right? So I hope this makes sense. I hope this is putting the things together, everything that we learned so far, putting it together. There's the time session, time and price, right? There's the Asia session right there. We know the Asia strong lows, so that 9% chance it will not get taken. And as you can see, it did not get taken. Look, our entry was literally on the Asia low. Look at that. It didn't get taken. You see that? Didn't get taken. So we combine everything together, the fractal nature of the market. Right now, there's many ways to see structure breaks, et cetera, et cetera, et cetera, but this is how I see it. Right. And eventually we're all going to adapt to seeing it in our own way. So this is it for this. Any questions, like always, let me know. On to the next one.